One of the biggest topics in mortgage right now is affordability. And it's not just the rates. We all know about the rates, what's happened with the rates. You turn on TV, it's nonstop. The things that are sneaking up on people are the taxes and the insurance. So when you purchase, the way to estimate what your taxes are going to be, Google your county property assessor, your county property tax. So if I'm in San Diego County, I'm just gonna Google San Diego County property tax. And then it's gonna pop up, and then I'm gonna search for the address. You can get the itemized tax bill. It will tell you the percentage, the tax rate, and then it'll show you the fixed costs at the bottom. It varies, but you can get this information pretty much county by county, almost anywhere. What you do is you take the new purchase price. If you're paying $500,000, if you're paying $1 million, let's say the property tax rate in California, what I'm used to seeing is 1.06 to like 1.23%. Underwriters will just use a typical general 1.25%, but I like to look at the tax bill for people, find out exactly what the tax rate is. You can see if there are Mello-Roos in the area. If it's a new build, there's probably gonna be Mello-Roos, the special assessment taxes, but you'll see the tax rate, and then you'll see an itemization of the fixed fees. If you see some really big ones, certain new build areas in San Diego County, you might get, outside of the regular property tax rate, you might get $6,000, $7,000 in special assessment taxes per year, and then you might have an HOA. So all those things you gotta be aware of. But where people are really getting caught is when the states, when they reassess their taxes. California is the most restrictive property tax growth state that there is. What you purchase a property at is your basis forever. And then from there, your taxable value, the most it can increase on any given year is 2% on any given year. So if you buy a property for $1 million, your taxable value is $1 million. The following year, taxable value can increase by as much as 2%. So 2% of $1 million, $1,020,000. Now you're gonna get to taxed at 1.15 or whatever your tax rate is on $1,020,000. But that is very controlled. That is why you can sometimes see somebody who maybe bought a house in Beverly Hills in say the 60s or 70s. That house might be worth $6, $7, $8 million today, but their property taxes in a given year might only be $1,000 or $1,500. When they sell that house for $5 million, $6 million, the next person is gonna pay property taxes of $55,000, $65,000 to $70,000, whatever it is, based on what they pay when they purchased it. But you can look up your property tax rate for a given parcel. Other states will reassess sometimes yearly, sometimes every 3 years. So you really gotta dig in and look up and figure out what property taxes will become or the reassessment schedule. Think of the pressure that we've been under since 2020. Just property taxes alone. If your state reassesses regularly, think about what's happened. COVID rolls around, everything gets shut down, Treasury floods the market with money, rates go way down, it creates a frenzy, a buying demand, property values go way up, but now it's COVID and supply is short. The cost to build has gone up because we can't get supplies, the supply chain is affected. It's putting pressure on everything, so the cost of supplies rises too. And then in turn, over the next couple of years, what happens, everybody's homes reassess, the property taxes reassess higher, things that people were not expecting with those property taxes, their property taxes might jump $1,000, $2,000, $3,000, $4,000 per year, maybe more. It just depends where you are. It depends on your state. It depends on how often it reassesses. So you really got to look at that. You can get qualified, you can get pre-approved, and it's based on when you bought the home, but you know, your 43%, 45% debt to income ratio at that given time, that takes account the snapshot in time of your personal liabilities that you can control, but you cannot control your property taxes. You cannot control your insurance. Insurance is another thing. There has been so many natural disasters. Again, since COVID too, the cost to rebuild has gone up. Certain states have subsidized insurance companies, but insurance companies, they might be maxed out on what they can charge in a certain state. If they're either subsidized or there's a cap on what they can charge, but the cost of replacement values and everything has gone up. Now, overall, on a national scale, they maybe need to hold a certain reserve fund, a specific amount of money, but if they're losing money at a rapid pace in a certain state, they might just pull out of that state. So some of that's happening in California. I mean, it's happening in Florida with the hurricanes, natural disasters, maybe the Southeast, North Carolina, everything that's happening. I know in some states, insurance is expensive anyway. Colorado, for sure. I'm not 100% sure about Texas, but I would imagine so. All of these things are creating pressure on the insurance industry as well. So it's becoming harder to get a good rate on insurance. Even since 2020, mid 2020, my homeowners insurance has doubled, full on doubled. Even when I shop it, it's still the best deal. So these are the hidden costs that are sneaking up on people. When I was at Cotality Connect 25 last month, this was a topic of conversation. They had insurance professionals there, and they really talked about this hidden cost because people don't anticipate this. It's out of sight, out of mind, but it's one of the things that is making affordability much higher, much beyond the rates. So it's very important that you're doing your research when it comes to your property taxes. And ahead of time, I will always dig into the property taxes for people and look, because we don't want any hidden traps. California, though, is very predictable. I will talk to people about how their property taxes will adjust. There's another thing too, in every state, the way that your property taxes will adjust initially, it's gonna be based on your purchase price. Look up the property tax rate for the parcel, and then you can look up different state rules, right? So what happens? I was looking up a property in Indiana for a friend last week, actually. Yeah, I pulled the tax bill. The actual tax rate for that particular parcel was 3.49%. However, they had caps. You look deeper into the caps. If you're gonna reside there, the max is 1%. So the cap is 1%, so it trims off that other 2.49%. If it's a rental property, the cap is 2%, and so on. If it's a commercial property, the cap is 3%. So you gotta look into the fine print, understand how the taxes will adjust, but there's supplemental taxes. These supplemental taxes, it's based on the purchase price of the property. So the tax cycle, it's delayed. Your purchase is not going to be reassessed into the property taxes right away. So the first property tax bill that you get may actually be the tax rate for the previous owner. And from the time that you occupied the property moving forward, there will be a supplement fill-in because your new property tax rate is higher than the person's before. Maybe the property taxes have been adjusted based on what you've paid for the property, but in between, from the time you took possession of the house to that next property tax cycle, your portion of it is missing. It's the previous person's tax bill plus a supplement. You can look for those supplements in the mail. Servicing departments often will not pay them. If you've been setting aside enough money into the escrow account, you call it to their attention, they will likely go ahead and get that paid for you. However, they'll tell you that you need to be on the lookout, you need to be responsible for that. But this often happens too, because if you don't see your supplement bill come through, if the servicing department hasn't acknowledged it or hasn't paid for it, now the end of the year comes around and you've been paying in X amount for impounds, and the servicing department thinks it's way too much money, but they just haven't accounted for those supplements and the future tax bill. But when they think that, they're gonna do their end of year balancing and they say, oh man, we've collected way too much money for this person. They're gonna send you a check back, and then all of a sudden the tax bill adjusts to what you've been paying all along. But now your monthly payment's lower because they thought your tax and insurance were lower. Now you're paying less than you should. And then the year rolls forward, you get to the end of the year, now there's a shortage in the account after your taxes and insurance are paid, and then there's a rebalance again. So you gotta look out for that stuff. Understand what you're getting into. It's very important to talk to your loan officer about these things. So bring it up, talk about the property taxes, talk about the impounds. A lot of times too, I'll talk to people when they're buying and say, hey, look, you can build in your taxes and insurance. However, your supplemental taxes won't hit for a little while. You'll have to bring more money to close. If out of the gates, you're responsible enough to pay your insurance one time per year and your property taxes 1 or 2 times per year, let's keep that money in your pocket, hold on to that money for other purposes, whatever you want to do with it, and take it from there. But if you want to build in impounds right away, you're going to bring more cash to close, and that's just how it goes. So talk to your mortgage professional about this. Look into the taxes, look for Mello-Roos, look for special assessment taxes, understand those HOAs, and HOAs too, they can change. Condos, there's stress everywhere out there. Affordability is a big deal. So make sure you do your homework. Have a great day.